So here in Canada, there are 4 areas where we can save and invest money. There's the RRSP, which many Canadians have heard. There's what's called a non-registered account. There is something called a tax-free savings account. And there is something called a permanent tax shelter. Okay. What I want you to think about when it comes to these 4 areas is each one of them is just a different bucket of tax laws. The growth can be the same, which we'll get into in a second, but it really comes down to how much tax am I going to have to pay in each area. And so we're going to go through each one right now. So when it comes to an RSP, most Canadians use RSPs for 2 reasons. One is they get a tax deduction against their income. This is something that most Canadians hear from their accountant. If they want to reduce their taxes, deposit money into an RSP. The second one is the money grows what's called tax deferred, which basically just means I don't have to worry about paying taxes now. I'm going to push that tax liability down the road. And we're going to show you what that looks like. But the challenge becomes is if you've ever withdrawn money from an RSP before, you know that there's a substantial amount of taxes that are owed. And the challenge is that every single penny that you withdraw out of your RSP will be added to your T4 and you will have to pay taxes on it at the end of the year. And so if we compare that to the non-registered account, most Canadians don't even know that a non-registered account exists. But you can actually have the same tax deduction in a non-registered account as you do in an RRSP. It's another step. It's a whole nother strategy that we can talk about another time. And the money can sometimes grow tax deferred as well. This really comes down to how are you actually earning the income or the interest in the account. But most people know this area by the type of tax they have to pay. The type of tax they have to pay is something called capital gains taxes, which means I have to pay tax on 50% of the growth on my money. And we're going to show you a scenario here at the end. Very similar up here, tax deductions, tax deferred, but I'm going to pay a lot less taxes in that area, okay? Onto the TFSA, most people might have a tax-free savings account through their bank, but when it comes down to it, right, we do not get a tax deduction, but the benefit is that when we withdraw the money, all of the funds that we withdraw are completely tax-free. Now, there's one challenge to the TFSA, and that is that we have a limit to how much we're allowed to actually deposit into that bucket. The limit right now is about $95,000 if you were 18 and over in the year 2009 when the program started. The permanent tax shelter, on the other hand, is a completely different strategy in and of itself. These 3 things here are governed under what we call security laws. This is actually governed under what we call the Insurance Act. And so very similar to a TFSA, there is no tax deduction. It grows completely tax-free. Okay. The big difference here is that there's no limit. The limit to the life insurance product is actually, how old are we? How's our health? What is our gender? And how much money can we actually afford to save there? Many advisors and many accountants will tell you that, if it's coming down for retirement, that the RRSP is the best place to save money. I believe that having money in every single bucket is probably the thing that makes the most sense because it allows us to manage our tax liability in the future. And here's why. When I sit down with most people, they tell me that they want to have about $60,000 a year, $5,000 every single month in retirement time. Now, if all of my money was saved in the RSP, we would have to withdraw almost $100,000, pay nearly a 40% tax. I do realize for, the engineers and the accountants that might be listening to this, it's an oversimplification, but we are going to have to pay a substantial amount of tax here in T4 income in order to get the $60,000 that I want in my bank account. Whereas if I took that same $100,000 from a non-registered account, if it was my money, I get to keep $100,000, which is fantastic. If it's pure growth, which is the worst case scenario, I'm going to get $50,000 completely tax-free, and I'll have to pay tax on the other $50,000. Now, I'm going to use the same 40%. I realize It's not 40, it's gonna be a lot lower than that. But again, sake of concept, I'm gonna end up with $30,000 here. These two things are gonna make me have $80,000 in my retirement time. Now, if you could imagine taking the same 40 years to save the same money that you saved, but getting to keep $80,000 a year in retirement instead of $60,000 a year in retirement, which would you prefer? Most people say the $80,000. And really, it's just about understanding that this area to invest actually exists. When it comes to the TFSA, if I was to withdraw $100,000 out of my TFSA, I would get to keep the full $100,000. And the exact same thing goes here in the permanent tax shelter, is you would actually ask for a line of credit for $100,000 and you would get to keep $100,000. Hopefully this makes a lot of sense. The last point that we always typically make is what we always ask people, which area do they think is the most riskiest one to invest in? And it's a little bit of a trick question because the risk on how much money I get to grow is actually about the type of investment that I have. So if I'm putting, a Fidelity mutual fund, I can put that mutual fund in my RSP, I can put it in my non-registered account, I can put it in my TFSA, and I could even put it in my permanent insurance. Okay, and so the risk when it comes to how much money I can grow or how much, potential money I could lose has to do with what investment fund that I'm putting it in, and the taxes have to do with which area do I put that fund into. So if this has piqued your interest, please reach out. We'd love to chat with you and share a little bit more about what we do.